gonna start.
Okay.
Anyway, I saw many familiar names here. So some of them are my friends. Some of them are my customers. So welcome all to join this session. This session is going to be, I would say, treat this like a round table. My goal is here to share again some of my tips and lessons that I learned that I thought might be helpful to grow your company, especially I'm a startup founder. I feel for startup companies which are small, we face many challenges. And when we go out, when we start talking about our product services, when we talk to investors, suppliers, lenders, being small sometimes is a little bit handicapped. So my goal here is to share my lessons learned and tips, and hopefully we can work together to level the playing field for startup, especially startup CPG companies. All right. If you have questions, feel free to drop in the chat channel, or if you want to raise your hand to speak, feel free to do so. I would say I would just take a pretty casual approach, treat this like a round table. I will see in terms of how the time goes, but I do have a 6-slide slide deck that I would like to walk through first. It encompasses a framework in terms of how startup CPG brands, you could frame your story and frame your positioning, and to build your financial numbers into your storytelling. So I would like to go through that first, and then hopefully after that, we can move into a Q&A session. We could do some case study exercises if someone volunteered to do that, or I could just answer questions. So that would be our general approach, and we will go from here. Sounds good? Cool. And with that, let me share my slide. Okay, so let me do a slideshow. Okay, so today again, we're talking about tips to unlock your brand's financial superpower. And specifically, this topic in my mind is actually really about strategic finance. So I come from a finance background. I started my finance career actually when I graduated from Wharton, actually more than a decade ago. So I joined McKinsey. I did a lot of financial planning analysis there, and later on I was a financial country head. Later on I was CFO for a number of startup companies, and then fractional CFO for a number of CPG brands, right? In my experience, especially when it comes to startup, meaning companies typically, I would say under 10 mil or even under like 1 mil or 2 mil. When you are at that stage, I think it's really important you think of finance as a strategic lever for you versus think of finance as some concrete numbers. And the reason I'm speaking that is because when you're so small, finance is an after fact. It is really a mere recording of what you have done in launching, in managing your businesses. When you're so small, when you just launch your product, when you're still figuring out your product market fit, when you're still trying to just test it out in one channel or in a few very limited channels, right? When you have just like one product or two products, very few skills, the finance is not a full picture of your potential. So when you think about finance, really tie that up with your strategy, with your overall, your brand's, I would say your brand's positioning and your brand's identity. So I like to present this kind of frame of reference for brands, especially when you're in small. So when you think about finance, not just think about finance, but think about your business strategy, think about your brand. So put it in the frame of everything about your brand and your company's growth, right? And I like to walk you through this strategic finance frame of reference for startup brands, right? So today, obviously, this session is specifically catering for I call underdog brands. And when I say underdog brands, typically it means you just started. You barely make some revenue. Typically, your revenue is probably could range anywhere from 100K to a meal or two, right? Or it could be a few meal, but let's say under 10 meal company, a startup brand company. So you are relatively small today compared to many, I would say, bigger and more mature brands, right? But when you think about your brand, not only think about today, but also think about your brands in at least 1 to 3 years time frame. So that's what I call frame of reference. So think about what your brand might be in the future. But if it's too far away in the future, it's very hard to concretize what you need to do today. So I suggest the frame of reference, the framework for thinking about your brands is think about today and think about where you would be in anywhere between 1 to 3 years, right? And then when you think about your brand, again, marry finance with your strategy. So I'd like to present a framework where when you think about your strategic finance in relation to your brand, think about, I would say, a dart chart, and think about layers of circles. Obviously, at the very core of this dart chart, the core is about your brand, product, and services. I suppose as founders, you are the master, you are the creator of your product and services, whether it's nutritional bar or whether it's a special type of beverage, right? Or if it's personal care, or some like a fashion, apparel, or beauty brands, you are the creator. So I suppose that's what you're best at. So I'm not gonna spend too much time on that, right? But I want to spend a little more time to talk about, I would say, in this framework, the immediate circle surrounding the core part of your brand, your product and services, is about your brand's I call strategic positioning. And I'm gonna explain to you what does that mean, right? I think when you're small, it's critical for you to carve out in this ocean of all the, let's say, food and bev brands, in this ocean of all the beverage brands, in this ocean of all the personal care brands, if to an outsider's eye, right, those are investor, lender, supplier, to an outsider's eye, this is an ocean of water drops. How can you strategically position your brand so that through the lens you present to the outsider's eyes, they can zoom in into this dark circle of your circle, and basically they can zoom in and read more about you and about your company, about your brand. So the immediate circle in my mind of this framework is think about your strategic position. And I'm gonna talk in more details about that in the next slide. The next circle after your strategic positioning, I would like to say is think about your brand's momentum, right? This momentum is probably some of the key milestones you have achieved since launch to date. Could be, since the since you introduced a new product or a new line, right? But whatever, think about once you carve out a space for yourself, like when you throw out this space to investor, to lender, to any partner, their eyes would like it will catch up their attention basically, so that they can zoom in to learn more about you, right? And when they zoom in to learn more about you, typically, I think you want to highlight what is your brand's probably latest and greatest momentum that you have achieved. I would also, in the subsequent slides, I would show you some examples of the narrative about the momentum you could present to outsiders' eyes, right? And then actually in my eyes, even though I have been a CFO for many years, obviously finance is my it's my daily thing, right? Is my job. But I actually think when you're small, think about your financial performance as an outer wrapper of your company. With the reasons I mentioned earlier. Number one, you're so small. Finance is an after fact. Is not a leading factor. Is actually posting factor, right? It's a lagging factor. So finance merely reflect your past monetary related traces since the company was founded. So it provides a type of lens to the outside investor lenders to kind of provide a lens for them to view, assess or take a impression of your company. But when you're small, I actually think of I recommend you think of finance more as a wrapper that you could basically wrap around your product and services, wrap around your strategic positioning, wrap around your brand's momentum. Meaning, when I say wrapper or kind of like a highlighter, right? It's you have the essential ingredients. I think the key role for finance or financial reports is to highlight those ingredients or put some kind of like a light on those specific ingredients. So overall, you could present to the investor or lender through the blended lens that when they view it, right? So when you talk about your story, when you put all those things together, finance becomes this like a sizzling thing that it makes your brand and your company even hotter, basically, or it has something like unique that would lighten up the outsider's eyes, right? So that's like my overall philosophy and framework, frame of reference I'd like to talk about. So when you're small, think of finance as a wrapper, or as I would say highlighter that could highlight your intrinsic strengths, either in terms of a product, services, or strategic positioning, or your momentum, right? Okay. So I'm gonna move, with that being said, I'm gonna move to the next slide, right? I see a chat here. Okay, so next slide. Sorry. Okay. So now let's talk about, again, assuming you are the master of your product services. I do think when you're small, and especially when it comes to CPG, right, there are many similar other brands. It's really essential you think of a simple way that I use time and time again is to think of your x-axis and y-axis in this basically market map, right? Assuming this is the whole market. Don't succumb to how other people categorize their a certain segment, but really think of why you founded this brand. What are the two most unique characteristics that cause you to want to to found this brand. So think of the X and Y axis that would always put you, your company, your brand in the upper right and in the upper right quadrant, basically. So I'll give you an example. It's my company's example. My company's myPocketCFO, right? I say we help CPG brand to make financial a superpower. But then what does that mean, right? What specific segment that we can claim as the leader, right? We can claim in this right and upper quadrant. So when I think about my X axis and Y axis, I would say the X would be we help startup brands to save time in bookkeeping, right? So that could be like one key benefit, could be one killer feature we offer is we automate your bookkeeping. So I would say on the axis, we think we excel at automating bookkeeping. And then on the Y axis, I would say we excel at data, I would say reading the meaning of the data, like a financial data clarity. And that's part of the reason, you know, I think I'm even talking about this is that what I have found out is for many founders who are not financial professionals, even when you're done with your bookkeeping, when you generate your P&L, your balance sheet, you don't know how to interpret the data. You don't get much insights or implication out of your data. If that's the case, then I would say that the financial reports failed in helping the founders to, you know, to achieve in growing your company. You know, the reports, the numbers doesn't make sense to you, right? So that's the part I personally, you know, I'm very passionate about this, and our company is passionate about this, is to help brands to achieve better or the most data clarity is to get meaning out of your financial data, right? So that's how we carve out, for example, my startup space. I can give you an example where many brands in our customer base, you know, some of them, they say, hey, I offer a clean ingredient wellness nutritional bar, right? This could be my one of my strengths. And then obviously there still are many, you know, clean label, clean ingredient or wellness, you know, oriented bars. So you really have to think hard about what is the two unique combination of the access that will really uniquely and permanently position you in this right and upper hand, right? In, you know, in one of my customers case, like basically the founder focuses on medical channel, for example, right? So basically, obviously, like in her case, she could say, actually, like our bot is medically graded. It's good for like cancer patient, for example, right? So you really have to, I would say, be very laser focused, like zoom in and think about what is the unique combination of X and Y axis that would undoubtedly put you in the upper and right corner. So when you carve out your own, literally your own market space or your own niche, it's clear to outsiders' eyes and ears right away, right? And then I'm gonna move to the next slide about the next outer circle is to present your brand momentum, right? So now you have your core product and services. You have your kind of the category you carve out for yourself. Typically, when you talk to outsider lenders and financial, you know, investors, you want to highlight your momentum. Some of the example, you know, some of the momentum would be, hey, we are and we are the new brand in this X and Y space, right? So you could see that, right? And you could see that positioning, and then you see our momentum would be because of that, right? We launched on this new health related new flagship store of I don't know, Whole Foods or whatever channel, right? Or retail, like retail brand. We launched on Amazon recently. We because of this, we got admitted into certain accelerator, and we will actually have a booth with the accelerator at Expo West or East, right? Some of the brands are, would go further in terms of getting a like clinic trial, have some scientific proof about some beneficial factors of your product. So you could say, here's my scientific study, right? Here's some clinic trial proof that our brand is actually superior. You could also mention some endorsement, obviously by some key influencers, whatever the price you have won, right? So those are examples. You could momentum. So momentum is another ramper to ramp around your product, services, and your positioning, right? The other example I listed here is, someone says, since launching 9 months ago, here are the progress we have made. We added 2 new products. We scale channels from DTC to wholesale specifically. And here are some customer testimonials. And typically in the momentum, depending on how early you are or how much the revenue milestones you have achieved, if you have achieved pretty significant revenue jump, typically I would recommend you to at least list one momentum as the financial momentum. It meaning like, here's our revenue jump from A to B within certain period of time. Some of the businesses are so early, right? You like revenue jump. Revenue again is a very lagging factor. It may not come up that quickly, which is fine. Then like the first example could be, you don't even need to mention any specific revenue number. So those are just different ways you could present your latest, greatest momentum, right? And then I would say, when it comes to the outer, pretty much the outer financial wrapper, keep in mind, obviously you're still so small. So those I listed out 5 key financial performance indicators here. Those 5, I call them, they're like most essential, most simple ones. Obviously, there are much more sophisticated ones, like customer lifetime value, CSA, marketing return on investment. There's a lot of ways to slice and dice your financial performance. But when you're small, again, my advice is like resist from jumping too much into the weeds. Because you're so small, there hasn't formed a pattern yet on your financial performance. So any of the like too detailed analysis may not be an indicator, may not be strong enough of a signal to say, hey, this is the past, therefore I can forecast or predict the future, and stick into some of the more fundamental financial metrics. And when I say the fundamental financial metrics, so just start with those 5 first, right? First, when you're small, it's all about growth. As you know, when baby, was born, they grow so fast, right? So you need to grow as a baby. Like every day it changes. In a month, like a baby would, probably double or triple, right? I think growth is really the most important key financial metric in my opinion. And it matters regardless of what kind of macro climate you are in. Like even though we're in a very tight macro climate, some founders asking me, should I turn to, reduce my expense to turn to profitability? I would say, hey, only that it does not sacrifice your growth. So if you do see very strong growth opportunity or signal, stick on to growth. Growth is always the most important financial factor for investor and lender and even partners, right? And when we talk about growth, you could grow by so many ways. You could grow by channel. You could grow in the same channel. You could grow month over month, quarter over quarter, just by by doing all kinds of marketing sales activity, right? So, but maintain it at simple and basic level. Pay attention to how you could grow. And then obviously the next fundamental metric is gross margin, right? Gross margin equals your sales minus your cost of goods sold. It's pretty simple. When you're small, typically I would say your cost of goods sold is pretty high because you cannot take advantage of the volume discount from your co-packer or your suppliers. So this gross margin, from my perspective, don't let it bother you if your initial gross margin is not optimized. I think that's just the nature of being small. Your gross margin would not be at its best because your cost of goods sold cannot enjoy the volume production discount, right? Nevertheless, start tracking that, right? What I want to emphasize for financial performance KPI for small startup company is pay more attention to your other than growth top line, pay more attention to your operating expense, right? And I typically like, if we do bookkeeping for you, we separate out, I like to separate out operating expense by two big categories. One would be I call sales and marketing expense. Or roughly we could think of this as a direct expense, meaning all the expense you spend here have something to do with your sales volume. If I spend more, my sales volume should go up. If I spend less, my sales volume should go down. So typically this I call this sales marketing expense on your P&L or on your chart of accounts, right? And under sales and marketing expense, you could list out all different granular types of sales. You could have obviously you could have all the web ads, the Google ads, the Facebook ads, the social media ads. You could have like a trade spend if it's more channel oriented channel, right? So you could then break it out into your specific. You could have a branding, and then you could have some sales commission if you hire sales people. So you could then break it out into different types of, I would say, sales expense, but with the goal that regardless of each subcategory, each spending should be directly related to your sales volume. So when you analyze this metric in the future, you should be able to see a direct correlation between your sales and specific expense you spend, right? And then I would say, for simplicity's sake, when you're so small, when you're so multitasking, you're doing millions of things, wearing so many hats, I would lump all the other expenses I call G&A expense. This would include potential salary, potential contractor pay, your rent, your obviously travel expense, office expense, all the other expenses. And you can think of this expense as a lump sum expense that needs to be allocated across your number of products sold, right? So the G&A expense, so think of it's not a one-to-one direct relationship or correlation to your sales. It's kind of a little bit like fixed cost. If you have to spend on something, you have to spend on something, or over time it will make a difference if you hire a contractor, but you cannot do the one-to-one, cost and causation kind of relationship. In this case, lump it into G&A expense, and then I would say start tracking the three types of things as percent of the two types of costs as percent of your sales. So sales focus on growth, And then there are really just the three types of expenses, and you should track those expenses as percentage of your gross sales. Obviously, gross margin is percent of your gross sales. For food and bev, it could range anywhere between, I would say, 30% to 50%, right? And pay attention to your sales marketing as percentage of your gross sales. I would say typically when you're small, the sales marketing or direct expense could be anywhere, again, depending on you heavily use DTC channel, or you go with the wholesale and the retail channel. It could range anywhere, again, from probably 20 to 50% of your sales. Pay attention to that, and that is definitely a category over time you should aim to optimize, right? And then pay attention to your G&A, meaning all the other allocation-based expense as percent of your total gross sales. Typically, the G&A, if you lump all the other things together, I would say should if you're aiming for break even, you literally say my sales is 100%, my gross margin is 50%, my sales marketing expense is 20%, then my G&A allocation expense should not be over 30% of my gross sales. That's how, like, literally on the back of the envelope, you can calculate and manage your G&A expense, right? Or if you say, I can afford I'm going negative because I'm in a growth phase, I need capital I can raise money, I can borrow some loan to fund my growth. Therefore, I could allow certain negative profit margin. Therefore, your G&A could maybe go up to 50% of your gross sales. So even though your net profit margin is -20, which is fine, and that -20 part can be financed by cash and capital injection from a lender, or from an investor. So think of this way, right? And then last but not the least, right, is always pay attention to your cash position and your runway. This is especially important key metrics for pretty much for any lender you talk to. They would want to know your cash position, and typically, in my view, it's a very high bar, but typically they would like if those lenders have access to your bank or to your P&L, they will want to make sure you have enough cash in all your banks to cover 6 months of runway. That's just a typical, I would say, a KPI they're looking at. So pay attention to that. In my view, a lot of startups, they don't have that level of cash, and their runway is short, but they still manage to, if your sales can feed you cash, your sales turn is very quick. If you can manage that, I think that's totally normal in a startup. Like you have less cash, but you manage much quicker growth on sales, right? And just FYI, in case you want to ask, your runway is calculated by your total cash position and end of the period, like let's say end of the month, divided by, typically you want to use your average last 6 months cash outflow number, which you can pretty much get from your bank or your P&L, your book. I would recommend you not just use your last month's outflow, because every month the cash outflow fluctuates. So typically you use the average of last 6 months cash flow. So you use your cash position at end of the month or end of the quarter, end of the year, divided by your last 6 months cash flow, you can pretty much get your runway. I would say, with that being said, I'd like to pause here. I've been talking a lot for almost 40 minutes. The last page is really about, going back to this methodology I presented in the beginning. Once you figure out your positioning, you list out all your most prominent momentums, and you have those financial key performance indicators, then the last step is really about, in your story, you just put all those elements together, and then you can formulate your own narrative. And once you put it out, whether you talk to an investor, talk to a lender, talk to a partner, or you put it in writing, or you put it in slide deck, you put all those things together. You literally use all those layers of wrappers to highlight and polish your unique product, service, and your unique brand. Put those together, and that should help a lot. So anyway, with that, I'm gonna pause here. We could do Q&A. We could, if anyone wants to share, volunteer to do an exercise, to put all the things together. I could help you to put your positioning, your momentum, and your financial key metrics together, all as highlighters to your story. We could do that as well. As I think I also offer some follow-up if we don't have enough time. If you want to talk to me separately, offline, specifically on this topic, or want to do exercise with me one-on-one, I do offer, there's a follow-up session to do that on Friday. All right. With that being said, I'm gonna stop sharing. Any questions or comments? Or someone wants to just share your doing exercise with me?
Don't be shy.
Yes.
We have Alice here today, so feel free to unmute if you would like to ask a question or drop it in the chat. Anybody want to volunteer to also just do a quick demo?
I saw some familiar faces. I'm gonna call up on someone, or it's better you do volunteer, right? I think it's that's the purpose of the session, right? Is try to craft your story so that it could shine in front of investors or lenders, right? Anyone wants to try? Or if you have a generic question about positioning your XY axis, if you have a question about financial KPIs, feel free to ask.
Alice, we have a question. When do you recommend against strengthening KPIs that a young brand raise capital?
When do you recommend against the strengthening KPIs? Can you elaborate on that? Whoever asked that question, I'm not sure I understand.
Hi, Alice. My name is Sledge Smith, and the question, to clarify, sorry it didn't make sense, is, looking at your slides, one of the things that stood out about them is the clarity of when a young brand is heading in the right direction, so far as what makes them credible to compete for raising capital as the time comes for them to potentially indeed need to do so. And so against what you laid out are the most important financial narrative criteria that people say, hey, this is a brand with great promise that could be going places. Is there a certain point or certain things that you see in metrics when you recommend to founders of CPG that they might want to consider, or should in fact you recommend that they raise capital at that point?
Okay, let me try to answer, and you tell me if I'm answering you your question, right? So whenever you go out trying to raise, and I assume when you say raise, you meant you're going to talk to a institutional VC. The reason I'm giving that context is it's very different when you talk to a, let's say, angel investor versus a accelerator versus institutional VC. The institutional VC will definitely put a lot more weight on your financial KPIs. So to talk to an institutional VC, you definitely need to prepare more to highlight more of your financial strength. Versus when you talk to an angel, it might be more about your story, a founder story. It might be more about your product and services, the uniqueness or the promise of your product services, and just some like a proxy size in terms of it may take off. It could be about how crazy customers are about your services, how unique this niche is. Really, there isn't any player, when you craft out that X and Y axis, right? So I don't know, does that answer your question, or is that going in the direction you're asking?
Yes, you're headed in the direction. I would further clarify, rather than the distinction being about what type of capital to raise, what source from, which I understand. I was wondering, in terms of your expertise, do you make recommendations based on how healthy those KPIs are, where you encourage or recommend that the CEO or the founders of a growing brand do in fact raise capital based on how they're managing their financial performance?
Gotcha. Okay, sounds good. I think it's not about me recommend founders when or how they raise capital. It's more about I think it's a founder's decision. It also sometimes it's based on circumstance. If they know VCs, they may as well just start talking about fundraising, even though they're small, even though they're even pre-revenue. So I believe a founder should make that decision. So when a founder makes a decision and comes to me as a fractional CFO, right, I typically, based on founders' use case, I typically I use this framework to highlight the financial performance of the company. A company could, and when you see the health, how healthy of those KPIs, I think when you're small, the healthiness, again, typically you would be, it's very hard to be carrying the flying colors on all KPIs when you're small. What I have seen a few patterns of the financial KPI would be, someone would, especially in their niche sector, they sign a lot of POs, for example, or they sign a PO with a very prominent retailer. That would be a very good indicator of their growth potential. Typically, when you're small, you focus on growth, you would be negative on profitability, especially for CPG, because you need a lot of upfront investment on product production. So that's why I'm saying the universal KPI in terms of healthiness, the number one, I would be looking at, or I would be discussing with my client, is definitely the growth factor, the growth KPIs. And then within the growth, I list out the 5 fundamentals, right? Typically on your P&L, you would only have the growth or revenue kind of in a more company level. What I would suggest, and I'm willing to work with the customer, is if you know your strategic positioning, if you know your specialty channel, what we work with customers is we make a specific chart of accounts for your company, so you could track that particular channel or that particular segment of sales in your P&L, or you could have different sets of P&L. You could have one P&L just to track, let's say, medical channel, or just to track certain segment that you are basically double down on the growth. Especially when you're small, you can't hit all the channels or generic. I suggest you typically focus on a very niche channel that you have high potential or high probability to claim a lead. in that channel or you know in a local environment. So that would be what I would be working with the customer, the founders with, is define your specific sales chart of accounts or sales by channel, sales subcategories, so you could track, and then and we could present basically as a KPI to the investors. And then on the expense side, as I mentioned, typically when you're small, I would just suggest you put it into simplify the expense side, simplify by just showing as category as percentage, the spending on the category as percentage of sales, and pay more, probably do more granular analysis on your sales marketing expense as percent of sales analysis. And then for the G&A, lump everything else into the G&A and just show G&A as percent of your overall sales. That's the way to present to investors. It's a way to guide the investor to highlight what your financial strengths might be. Does that answer your question?
Yes, that was excellent. Thank you very much. May I ask one more? When do you
Sure.
recommend as a fractional CFO that it's time to get a permanent in-house CFO?
That is a great question. I would recommend, the short answer, again, it varies, but the short answer is typically, I would say, if you're on the VC raising track, like you foresee your brand is going to raise capital, typically I would say after Series A, you could consider having a in-house. Sometimes it could be after Series B, but I would say anywhere between after Series A and Series B. That's because when you get Series A, Series B, because typically that's in financial term, that's called a priced round. A priced round would require, you know, SEC filing, would require you to file if it's not audited, but really reconciled, it will have much more restrictions on financial reporting and compliance. For that purpose, you need a in-house might be needed. And the other thing is after you raise A or B, you're in the growth mode, right? In the venture capital's world, you need to scale up quickly. And you need a lot of growth capital. So you may need to talk to CFO on a daily, weekly, monthly basis about how to strategically raise the next round, how to strategically do like a venture debt or any other types of alternative debt. So that portion of the work becomes more prominent and more time consuming, or more time is needed for you as a founder to work with a finance professional. And that may warrant a full-time CFO or some significant time spent on the CFO side. Because CFO typically covers, I would say, strategic finance. Would part of that is financial analysis and planning. And then the other part is really about fundraising. Cash and capital is a very important and key part of CFO. And the third part, I would say, treasury function, which is to manage your cash flow. Those three functions are pretty integral part of a CFO's job. So if you anticipate a lot of time to be spent on those three areas, you need an in-house CFO.
Excellent. Thank you so much.
You're welcome.
Great.
There's another question, right? I think Christina, you're asking, is it okay to use assumptions for financial performance if you don't have a lot of sales right now? Christina, are you still here?
Yes, I'm still here.
Okay. Can you elaborate a little bit more or give me more context?
Just asked that question was because for my company, we're in like financial raising right now, and we just wanted to know like if we could use assumptions because for the financial performance, because we don't have a lot of sales right now. So we're hoping with angel investors, you know, we could use that funding to scale our incoming sales once we produce the product.
Right. So that's a good question as well, especially for early stage and you're just launched companies. I typically recommend, yes, you can use a lot of assumptions, but make sure like market, like indicate that clearly and saying this is, like I use many words like projected growth for 2023 or projected growth for 2024. Or you say this is preliminary based on our assumptions, based on our PO or our discussion with certain certain wholesaler or retailers, because that kind of discussion may go on for months. But if you say clear indication, they may give you a PO or something, you could put it on your statement. The other thing is, your accounting is a fact. So you cannot put like accounting has to be fact-based. So you have to that's why like in the future it can be audited, right? Accounting is purely based on what happened transactionally. If it doesn't, like if it's just a PO, like even PO does not get into your revenue. Just so you know, many customers ask, hey, can you put PO into my sales? The honest answer from our CPA or from our bookkeeping team is no. PO is not. It's just a promise to buy this much in next 6 months or 12 months period of time. So your accounting book it is fact-based. There's no wiggle room basically. But you can like once you generate a P&L, what I typically advise my client to do, or sometimes work together with a client, is on that P&L you could add additional row. You could add, say, like a expected contracted value or expected PO value. Add those as additional rows on top of your revenue, your happened revenue. And those would be indicators to the investor to say, yes, this is looking in the future about a years down the road. This is how much I expect to bring sales. Does that help?
Yeah, no, that was a good answer. Thank you.
You're welcome.
So thank you all again for joining us today. Truly appreciate it. Thank you to Alice and all your wisdom and for being a part of Naturally New York, even though you're on the other side of the country. But again, thank you all for joining again today, and we will see you again soon.
Thank you. My pleasure to be here. Talk to you next time. Bye.